The rich don't invest like you. And that's exactly why they get richer every single year. Most people follow popular advice and quietly lose thousands without even realizing it. Welcome to the Money Cipher X. This is where we break down how money really works, how the wealthy think about investing, and why most financial advice keeps people stuck. If you want clarity instead of hype, you're in the right place. Today, we're breaking down 3 investment habits the wealthy actually use, not what gurus sell, not what social media promotes, and definitely not what most people copy. By the end of this video, you'll understand why the rich play a completely different game and how that game actually works. Here's the mistake most people make. They think the rich take more risk. In reality, they take smarter risk, and it starts with the first habit. Most people hear the words index funds and immediately think boring, slow, and average. But here's what almost no one tells you. The rich love index funds, just not the way most people use them. While the average investor buys random ETFs and hopes for the best, the wealthy focus on 3 specific rules: ultra-low fees, long-term compounding, and tax advantages. They don't chase hot stocks, they don't panic sell, and they don't constantly trade. Instead, they put large amounts of money into low-cost ETFs inside tax-advantaged accounts, letting time and math do the heavy lifting. Here's the part that shocks people. Over 90% of professional traders fail to beat the market long-term. Yet boring index strategies quietly outperform most of them. That isn't luck, that's discipline. But index funds are just the foundation. This is where the real separation begins. While most people fight over public stocks, the wealthy invest where most people can't see. Private businesses, real estate syndications, private equity deals, alternative assets. These investments don't move every day, they don't trend on social media, and they don't create hype. That's exactly why the rich love them. Private assets offer something public markets don't: control and stability. Instead of reacting to daily price swings, wealthy investors focus on long-term value creation, cash flow, ownership, and strategic growth. Many billionaires built most of their wealth before their companies ever went public. By the time the average investor gets access, the biggest gains are already gone. That's why the rich don't just invest in the market, they invest before the market notices. But here's the biggest difference of all, and this one changes everything. Most people invest hoping that one day their assets will be worth more. The rich invest so their assets pay them every single month. Rental properties, dividend-paying companies, royalties, businesses with predictable income. They care less about flashy growth and more about reliable cash flow. Why? Because cash flow buys freedom. It pays bills, it covers expenses, and it allows reinvestment without selling assets. Here's the irony. People think cash flow investing is risky, but relying on a single paycheck is far riskier than owning assets that pay you from multiple directions. That's why the wealthy focus on income first and appreciation second. So let's recap the real strategy. Use index funds strategically, not emotionally. Invest in private and alternative assets when possible, and prioritize cash flow over hype and speculation. This isn't flashy, it isn't fast, but it works, and it's exactly why the wealth gap keeps growing. If you want to learn how the rich actually think about money, not the advice everyone repeats, subscribe to this channel, because once you understand the rules of the game, you stop playing to survive and start playing to win.